Welcome to the Connors Corner segment of Ask the Lawyer. You know, we're into a new year, and we have with us one of our old friends, Bill Markle from Markle Wealth Strategies. And we want to talk about basically what's the financial outlook for the next year. Bill, welcome back.
Thanks, Mike. Always good to be here. Happy New Year to everyone.
Okay.
I do have to read my disclaimer
Go ahead,
here
read
as
your
required by the regulators. I'm William Marco, Certified Wealth Strategist, securities offered through Cetera Advisors, LLC, broker-dealer member of FINRA, SIPC, advisory services offered through Cetera Investment Advisors, LLC, a registered investment advisor. Cetera is under separate ownership from any other name entity, and our main office is located at 114 Seguin Avenue, Staten Island, New York, 10309.
Okay, Seguin Avenue?
Seguin.
Okay, all right. So, what's your outlook for 2025? Nobody really knows, but you got a better handle than a lot of people financially, investment-wise, business-wise, and politically, too.
Yeah, so, the expectations is that we're going to have a good 2025. We're coming off markets that I think had returns of in the 20% for the last 2 years. With the new administration coming in, they're certainly talking about tax cuts, which, by the way, the Tax Act from 2018 that President Trump had signed is sunsetting at the end of this year. So that'll be interesting if that gets extended or maybe even enhanced to some degree. Corporate taxes would be impacted, personal taxes and various state taxes would be impacted. But the outlook is pretty positive. I think we're seeing that reflected in recent days in the market, with the expectation that we may see some tax policy, favorable tax policies extended or enhanced, and deregulation. I mean, some of the people that are being put in place is there to.
Let me ask you what about the salt tax? Have you heard anything?
Yeah, it's funny. One of the things that is expiring is the salt tax, and that will revert back to no cap. I believe that they will address it in some way. What I've heard is they may raise it. Maybe it goes away altogether, but I haven't heard anything definitively.
Because that's one of the things, the Democrats cried about it, but yet they were in power and they didn't do anything about it whatsoever, which, that goes without saying. But what do you think of Trump's proposed cabinet appointments that you know of?
Yeah, I like most of them. I don't dislike anyone in particular. I like the fact that, certainly Treasury Secretary, who'll be hopefully appointed, Scott Bassett, is a hedge fund manager. So business folks, Commerce Secretary Howard Lutnick, who formerly, I think he's still the head of Cantor Fitzgerald, certainly a businessman. I think that's a great post. I don't know much about the energy appointee, Chris Wright, but again, a business owner. I mean, me personally, as a business owner, maybe I'm a little biased, but I just think that business owners tend to evaluate things a little bit more objectively and make decisions that are usually more correct than not, rather than have a politician do it.
Okay. Now, talking about the tax cuts, I mean, a lot of our audience is interested in the state taxes. And hopefully, I mean, I don't think there's any doubt we don't have to worry too much because it's going to be $14 million this year. Mm-hmm. And I seriously doubt if there are going to be any cuts to that and if not increases, which means for a husband and wife, as far as the federal estate tax goes, we got $14 million. It's very easy with portability to make it 14 times 2, so $28 million, which means the death tax really isn't a problem federally for a lot of our clients. Now, New York State has a tax on $7 million. And, of course, what some people are unaware of is that, you read somewhere that there's no tax on the first $7 million, and then you have $8 million, and then you do no planning, and your kids are paying $800,000 in taxes in today's law, which is incredible, but that's what it is. And hopefully at least we won't have to worry about the federal government, but we still have to worry about New York State.
I think a lot of people miss that. They think federal all the time, even on their personal tax.
Well, you read magazine articles.
Right.
And you see there's no federal estate tax under $14 million and say, I don't have to worry about it.
Correct.
And then, like I said, $8 million, you pay $800,000, which the shame of it is, like you live in Staten Island, you move to Elizabeth, New Jersey from Staten Island, maybe move in 5 miles. And if you live in Staten Island, you got a $10 million estate, your kids are paying $1 million in taxes. That's assuming you're single because there's no tax between husband and wife. But you move from Staten Island to Elizabeth, there's no death tax, estate tax in New Jersey to children. There are to nephews and nieces, but not to children. So you got a $10 million estate, you live in Staten Island, you move 5 miles to Elizabeth, New Jersey, and your kids pay no tax, which is great.
I can reach Elizabeth, New Jersey with a 9-iron. I'll miss it.
Yeah, right,
about
exactly.
40 yards to the right, but I'll make the distance. I think what my observation, I study human nature in this business a little bit, is that people are often surprised of what their net worth actually is. And with the increase in real estate values, which, by the way, has helped New York City cover a lot of the tax base because the real estate taxes have been going up based on the value of the homes increasing. They're very surprised that they hit those numbers when they sounded like they would be out of reach. Another interesting fact, we do insurance, of course, and we're insuring people up to age like 105 or 115. And they'll go, who lives to that? And I'm saying, well, a 40-year-old today likely will because their grandmother's 96 right now, so it's possible.
I see a 90-year-old client every week, I think without doubt. And it's not, it used to be extremely unusual to see somebody over 100, but it's not anymore.
No.
It happens, but somebody 90 is, a weekly occurrence. And of course, if you have the genes, my understanding is if you have the genes to make it to be 90, you got the genes to make it to be 100.
I agree.
Because most diseases kill you between 78 and 82 and 83. And if you get past that, you got a good shot to make it to 100.
Yep, and with artificial intelligence in the medical industry, I think we're going to see a lot more in that respect where people are going to not only live longer, but maybe have quality of life, which comes back to planning, right? Planning, and I think this is a unique situation here. As we mentioned, the taxes that were approved in 2018 are due to expire at the end of the year. Now, the likelihood is that they may extend it because you have a Republican Congress, the Senate, and you have President Trump. But I think this is a unique time to do the planning. Shouldn't wake up on January 1st, 2026, and find out that it was changed one way or the other. I think it's a good time to have your estate reviewed. Whether you've done your estate planning already, it should be reevaluated under the circumstances, and certainly financial planning. We mandate that we meet with our clients either by phone, Zoom, or in person at least once a year. And this is going to be a pivotal year to make those meetings for the purposes of the changes in the tax code, the estate planning, and things of that nature. So I think this is unique. I think people should take advantage of getting consultations with the professionals that they need to talk to.
Well, factors are always changing. A lot of times, even sometimes we come in, people did their wills 30, 40 years ago, and they had their brother as executor. Now their brother's 80 years old, and their kids are 40, and they were too young to be executors, 30 years ago, but now it's appropriate to change it. But, I can just imagine the financial world, it's even more so. The different types of investments are popping up. Mm-hmm. I'm sure you must have products now that you're selling that you didn't even think about 10 years ago.
Yes, certainly allocation's a lot broader, and there's a lot more choices out there. Some of the private equity options that you had to be an accredited investor or you had to have so much in net worth are now coming in package formations that are allowing middle-class folks to invest in if it's appropriate. So there's been a big changeover in the financial markets in terms of the investments they can choose, the allocations they can choose, and the professional management of those allocations.
Can you give an example of that?
Well, you have like real estate. At one point you had real estate investment trusts. Now you can buy funds of real estate. You can buy private real estate through an investment account. You can work with hedge funds, and you could work with various private equity companies that invest money, and you can buy into their partnerships through various investment platforms that they offer. We do most, if not all, of our investments under the fiduciary rules. I was acting as a fiduciary for over 30 years prior to the government telling me I needed to be, but now we follow the rules that they enacted. Matter of fact, if you check my name on the broker check, I'm going to knock on wood here, but I don't have one violation in 30 years. I'd like to think that I'm more lucky than I'm skillful, but it's not, so fiduciary process is at hand. And investments should be made after careful consideration of not only your objective, your investment experience, your time frame, but also your taxes. We do a lot of tax management. We're not CPAs, we're not tax accountants, but we're mindful of the taxes. And as I tell my clients or possible clients, the advisor down the block and I can make you the same returns, and we could be off a couple of percentage points. But the difference is we're going to focus on the tax code and mitigate taxes where necessary, or build a portfolio that's more tax efficient for you, because there you're saving that federal tax or possibly that state and local tax, or reducing it to a good amount.
Can you give us a good example of that? What kind of product you could do to lower those taxes?
Well, we like, in many cases with high net worth folks, we like SMAs, separately managed accounts, because in those capacities you own the individual securities. You actually own the underlying securities. Therefore, you're not in a fund where if somebody else is selling it, you may get a capital gain because the managers had to liquidate the portfolio at that time and took a tax, got hit with a capital gain tax, and they passed that on to the investors. So we like SMAs, we like municipal bonds in that capacity. This is not financial information. You need to speak to your professional advisor prior to investing. But these are the categories that we look at with high net worth folks. But one thing that I do is I do tax harvests, and I don't wait to the end of the year to do that. And that's basically taking any losses and realizing those unrealized losses to realized losses, so that my clients can take it to their accountant and offset their capital losses versus their capital gains, or reduce their income tax. So in 22, as an example, markets were down terribly. It was a great year to do that tax harvesting. And we did it, and I don't only wait to the end of the year like most, I do it throughout the year, because you don't lose it, you carry it over. If you carry a capital loss, you carry it over until you have capital gains to offset it against. And you could be reducing your taxes quite a bit, so it's what you keep that makes
And
the
I
difference.
just want to mention to some people out there, because I think it's overlooked a lot. Somebody, let's say you inherit a house from your parents, grandparents, whatever. You have the stepped up basis. And when you sell the house, when you pay your broker and you do your closing costs and attorney's fees or whatever, that is a loss. And you can take that loss and use it to some advantage. Let's say you sell your house for $1 million, and let's say it might be a little high if we said $100,000 in closing costs. That would be high. Mm-hmm. But let's say a combination of paying a broker and the transfer taxes you pay to New York State and the attorney's fees or whatever. So let's say you have a $100,000 loss. Tell them how they can use that to their advantage later.
Yeah, they should speak to their CPA and tax accountant and make sure realizing those losses. And, I often say, if you want to be wealthy in this country, or you want to gain wealth or have generational wealth, know the tax code. Okay, know the tax code and the rules and regulations. You don't have to be an expert about it, but make sure the professionals that are managing your portfolios are aware of the tax code, that they're just not investing the money, because pretty much anyone can do that. I won't say anyone, but more likely they can. It's also incorporating the taxes to make that happen. And to your point, Mike, make sure when you're taking losses, or you have the ability to do so, that you're bringing it to the attention of your accountant and have them put that on your return.
Because I know a lot of times when people sell real estate out of a trust or out of an estate, they don't realize that, of course, they have the stepped up basis. So let's say the property's worth $1 million on date of death. And again, you take your broker's commission, you take your transfer tax, you take your attorney's fees. Maybe if you have trustees' commissions, you take it all up and add it up. And let's say you do have, $100,000. That's $100 loss that you can use and sell stocks at some point and offset the gains.
Right, and maybe liquidate some money so that you have some access to it. You've been holding off because you didn't want to pay the tax, and here's your entry point to maybe offset that gain against losses and not really have to take money out of your pocket to pay it. I do want to add, I mentioned tax harvesting. There is a wash sale rule with that, so I encourage anyone that looks that up, or if you're going to do it, please speak to a professional about it, because there's a wash sale rule. If you sell something, you got to wait 31 days before you can buy it back, or it voids the tax loss.
All right. Is there anything else you want to mention to our audience in the last few minutes here?
I want to mention that I think when I go to the gym, I often overhear some conversations that go on, and you hear some folks giving out estate planning advice, financial advice, tax advice, and then when you hear what they're saying, sometimes it's dating the policy that was in effect back 5-10 years ago. They're going over old codes, like you could sell your house, and if you buy another one, you could offset it by the cost of the other one. No, there's $250 exemption for a single and $500 for a married.
I do want to. There's another thing that a lot of people don't know. Let's say you've got a husband and wife, assuming the house was jointly husband and wife, tenants by the entirety. If, let's say, the husband dies, the wife gets the stepped-up basis on half the house. Right. A lot of people don't realize that. So let's say, getting back to our $1 million house, husband dies, house worth $1 million. The wife gets a stepped-up basis on the husband's half, $500,000. If she sells within 2 years of his passing, she keeps his $250,000 exclusion, and she has her own $250,000 exclusion, so she can sell the house tax-free. A lot of people, again, don't know about that,
right.
and that's something that, when I explain that to people, I'm astonished how few people really seem to know that.
Yeah, I think it's either the lack of knowledge or worse, misinformation, which can really hurt you, right? You can't fix these things the day after. Mm-hmm. And that's why planning and reviewing and making sure you have to focus on it 12 months out of the year, but at least once a year as you check your health. If you have a certain net worth or you're a certain age, you should have your insurance, your financials, your estate. Make sure things are locked down. Life changes quickly. You may have children, grandchildren, could be special needs, various things that you need to be aware of. Yeah. So get the information.
And remember, New York State's out to get you if you got a net estate over $7 million. I mean, again, it's incredible at the numbers, but I haven't done the numbers for this year yet, but let's say last year was $6,940,000 tax-free. If you had a net estate of $7 million, you're paying $250,000 in taxes.
Yep.
It's going to be very similar this year.
Yep.
They haven't given you a break on that one.
Yep. I think one of the things that really worries me when I hear it, and I usually barge in, I'm going to take the house out of my name and put it in the kids' name.
Oh yeah, well that's a disaster.
You just transferred your cost basis on that house that you purchased 40 years ago at $100,000 to be about a $900,000 gain. And I go, no, you don't want to do that. You want to make a call to Connors and Sullivan and get advice on other ways to make that happen.
Because we can do a trust, still keep some hooks attached, strings attached, where we get the stepped up basis when you're gone, and that $1 million house will go to your kids tax-free at $1 million. Where if you just give them a house you paid $40,000 for, which it seems every one of our clients paid $30,000 or $40,000 for the house.
I know, it's amazing.
And then your kids sell it for $1.5 million. All of a sudden, they got a $1.4 million capital gain, assuming they don't live in the house. But even if they do, they only get the $250,000 exclusion.
Right. As compared to taking a whole 1.5 and making a big difference.
And especially now with the death tax under $7 million, even New York State, $7 million, we can multiply that by 2, and we get $14 million out tax-free. So that covers most of our clients. Bill, where can they reach you again? And do you have to do the whole disclaimer? Or can
I don't believe I have to do the whole disclaimer.
You gave the disclaimer once, so let's...
I realize it's a short time frame.
And tell them how you work your business model.
Yeah, so we give free consultations. We follow 13 wealth management issues. Many of them don't involve what a financial person would normally do. That's why we get involved with estate taxes. We do Social Security maximization, Medicare planning, college planning, business succession plans, various things like that. There's 13 of them. I can get you a copy of it. We do a free consultation. Often I say the reason why we do it for free is because nobody's going to work harder for you. If we sit down with you, you're going to be covered from not only the investments, but how your children, your grandchildren, your loved ones inherit their money, how we tax manage your portfolio to mitigate taxes where possible, and we bring in true professional investment management style that put together the portfolios that are appropriate. And then we review them at least once a year or more often to make sure they're still meeting our needs. I have a couple of offices, but the main one is in Staten Island. Phone number is 718-967-3106. And give us a call. Be happy to talk to you.
Give that phone number again, just for those people picking up their pencils right now.
Sure. The phone number is 718-967-3106. It's William Marco Wealth Strategies, Staten Island, New York.
And if any of you out there are interested in meeting with Bill, if you want to meet him in one of our offices, you're more than welcome to come on over to our office and we'll schedule an appointment.
Great. All right. Thanks, Mike.
All right, Bill, thanks again for
Thank
coming
you.
by.
Oh, always a pleasure. Always good to be in Brooklyn.